Ever wondered why governments can't just print more money to pay off debts or make everyone rich? It seems like such an easy fix, right? Well, today we're diving into the economics of printing money. And trust me, it's a lot more complicated than just hitting print on a giant money machine. So, picture this. A country decides to print a ton of new cash. Suddenly, everyone has more money in their pockets. You, your neighbors, everyone. What's the first thing you'd do? Probably go on a shopping spree. You'd buy that new phone you've been eyeing, maybe a new car, or finally book that dream vacation. And you wouldn't be alone. Everyone else is thinking the same thing. Now, here's where the problem starts. The number of things to buy, the phones, the cars, the vacation packages hasn't changed. The supply of goods and services is still the same. But the demand? It's gone through the roof. Everyone wants to buy, and they have the cash to do it. What do businesses do when they see this massive surge in demand? They raise their prices. That loaf of bread that used to cost $3? Now it's 5. That t-shirt you wanted? The price just doubled. This is called inflation. Your money is suddenly worth less because it can't buy as much as it used to. The extra cash you have is essentially canceled out by higher prices. In the worst-case scenario, this can spiral into what's called hyperinflation. Let's look at a real-world example. Zimbabwe in the late 2000s. The government started printing money like there was no tomorrow to deal with economic issues. The result? Prices were doubling almost every single day. People were carrying wheelbarrows full of cash just to buy groceries. The government even had to print a $100 trillion bill. Eventually, the Zimbabwean dollar became so worthless that the country had to abandon it and use foreign currencies instead. Another classic example is the Weimar Republic in Germany after World War I. To pay off massive war debts, the government fired up the printing presses. By 1923, hyperinflation was so bad that prices were skyrocketing by the hour. People were using money as wallpaper or to light their stoves because it was cheaper than actual wallpaper or firewood. It was a complete economic collapse that had devastating social and political consequences. So, if printing money is so risky, are there any situations where it's a good idea? Well, sort of. Central banks, like the Federal Reserve in the U.S., do create new money, but they do it very carefully. This process is often called quantitative easing, or QE. Here's how it works. Instead of just handing out cash, the central bank uses this newly created digital money to buy assets, usually government bonds, from commercial banks. This gives the banks more cash, which they can then lend out to people and businesses at lower interest rates. The goal is to encourage borrowing and spending to stimulate the economy, especially during a recession when things are slow. Think of it like adding a little bit of water to a thick soup to get it flowing again, rather than flooding the whole kitchen. The key is control. Central banks closely monitor inflation and the overall health of the economy. They aim to inject just enough money to keep things running smoothly without causing prices to spiral out of control. It's a delicate balancing act. If they do it right, it can help prevent a deep recession. If they get it wrong, they risk creating the very inflation they're trying to avoid. So what's the big takeaway here? The value of money isn't just about the number printed on it. It's about trust and what that money can actually buy. The real wealth of a nation comes from its productivity, the goods it produces, and the services it provides. Printing more money doesn't create more goods or services. It just spreads the existing value more thinly across more pieces of paper. It's like cutting a pizza into 16 slices instead of 8. You have more slices, but the total amount of pizza is still the same. Each slice is just smaller. That's essentially what happens to your money's purchasing power when a country prints too much of it. So, while printing money might seem like a magical solution to economic problems, the lessons from history and economics show us it's a dangerous game. A stable and prosperous economy is built on production, innovation, and sound policy, not on a printing press running over time. Thanks for watching. If you found this explanation helpful, don't forget to hit that like button and subscribe for more deep dives into how the world works. See you in the next video.